The North American energy landscape has undergone a seismic shift as Canada's Trans Mountain pipeline expansion reaches near total capacity, hitting utilization rates in the high 90s, a full 2 years ahead of industry forecasts. This development marks a definitive turning point for a project once widely dismissed by Wall Street analysts and energy consultants as a $40 billion failure. Originally a 1950s-era line carrying 300,000 barrels per day, the expansion was designed to triple capacity to 890,000 barrels, providing Alberta's oil sands with a direct artery to the Pacific coast at Burnaby, British Columbia. The project's history is defined by extreme volatility, including a 5-fold budget increase to $34 billion in Canadian taxpayer funds, regulatory gridlock, and the eventual 2018 federal buyout from Kinder Morgan. Despite the project opening in the summer of 2025 at only 84% capacity, triggering widespread skepticism and public statements from Trans Mountain CEO Mark Mackey that full utilization would not occur until 2027, the infrastructure is now operating at its physical limits. This surge in volume effectively ends Canada's historic dependence on the United States as its sole customer, establishing a permanent and operational link between Canadian heavy crude and the high-demand markets of the Pacific. The sudden acceleration of Canadian energy exports is directly linked to a geopolitical crisis in the Middle East that has reshaped global supply chains. On February 28, 2026, coordinated military strikes by the United States and Israel against Iranian targets triggered a rapid retaliation. By March 2, 2026, Iran effectively closed the Strait of Hormuz. This 21-mile-wide waterway serves as the transit point for 20% of the world's traded oil, approximately 20 million barrels per day. The closure immediately stranded supplies from Saudi Arabia, Iraq, and the United Arab Emirates, leaving the world's largest oil importers, China, Japan, South Korea, and India, without their primary sources of crude. Faced with an immediate supply vacuum, these Asian markets pivoted to Canada as the only stable, Pacific-connected alternative capable of high-volume exports. Consequently, Trans Mountain's utilization jumped from 84% to the high 90s in mere weeks. This shift has created a strategic crisis for the United States, which currently imports 4.4 million barrels of Canadian crude daily, representing 63% of all American crude imports. Industry data confirms that refineries on the U.S. Gulf Coast are specifically engineered to process the heavy crude produced in Alberta. These facilities cannot be easily reconfigured to handle other grades of oil, a process that would require billions of dollars and years of engineering. As Asian buyers secure test shipments and move toward long-term contracts via the Trans Mountain terminal, the available supply for American refineries is narrowing. Mark Mackey has confirmed that if these Asian refineries find Canadian crude to be reliable and price competitive during this crisis, they are expected to seek long-term commercial agreements. Such contracts would place Canadian oil exports beyond the reach of U.S. executive orders or domestic policy changes, structurally altering the North American energy trade. The Canadian government is currently advancing a multi-track infrastructure strategy designed to institutionalize this new market leverage. Beyond the current Trans Mountain operations, a 300,000 barrel per day expansion is already planned through pumping station upgrades and the use of drag-reducing agents with a target date of 2028. Simultaneously, the Prairie Connector project, a 450,000 barrel per day line from Hardisty, Alberta to the U.S. Gulf Coast, is moving through its final commercial assessment phase. On March 24, 2026, the White House confirmed it is fast-tracking the border crossing permits for this project to secure supply for American refineries. Furthermore, Alberta has submitted an application for the Northwest Coast Pipeline, a second Pacific export route intended to move an additional 1 million barrels per day. The application deadline for this project is July 1, 2026, coinciding exactly with the joint review of the Canada-United States-Mexico Agreement, CUSMA. This convergence of deadlines places Canadian negotiators, led by figures such as Mark Carney, in a unique position of strength as they face American demands regarding dairy quotas, auto rules of origin, and digital trade regulations. While the surge in oil prices to over $100 per barrel has bolstered Canadian federal and provincial royalties, it has also introduced significant domestic inflationary pressure, increasing fuel and heating costs for Canadian households. The long-term consequences of this shift depend on the duration of the Hormuz closure and the speed at which long-term contracts are signed with Asian buyers. If Canada successfully locks in these new markets, it will represent a permanent decoupling from total American market reliance. As the July 1st negotiation date approaches, the integration of Canadian energy into the global market remains the primary variable in North American trade relations. For more updates on the Prairie Connector assessment, hit subscribe.